let's get started. We're a few minutes in, so I think it's the perfect time. So again, many of you already reviewed the material. We have a website. The landing page is generationalwealthmd.com/Indiana in lowercase, where you have all the deal specifics. We always have a slide deck on there. We have the highlights on the page to keep it simple. But if you want to go into the details, there's a slide deck on there. All of that's available for you to take a look at. I'm going to spend some time today to go over some of the highlights and then some of the metrics that we use when we analyze the deal. And I think as an investor, you need to do your own due diligence. Well, I'm also excited to announce that we are going to come up with an entire ebook for those of you who are interested in investing passively in real estate syndications. That's coming out, hopefully, fingers crossed, end of this month. And it's basically going to show you how to do your own due diligence. So as always, we're committed to educating you. And so if you invest with us or if you're here to learn, whatever it is, we're here to support you. Okay, so let's dive into the deal. Before we get started, I know most of you on here, but for anyone who is new to the community, I'm Param. I'm a radiologist in Southern California. And I had a rough career transition. And many of you have heard about that in the past, but that's when I realized the significance of financial freedom and passive income and decoupling my time in medicine from actual income. I used real estate to accelerate my journey. I now work part-time in medicine. I work a few days a month in medicine, but that's when I started building out the community. Generational Wealth MD right now is at 10,000 members. And our goal has been to educate. So we're mostly physicians. I would say 80% of our community is physicians, but it's mostly to educate people and help them overcome the barriers that exist to investing in real estate. And then as we grew the community, what we realized is that initially we were talking more about direct ownership, but the majority of our community is people who want to invest passively in real estate. And so that's when we created GW Capital. And the mission was, again, to provide vetted, curated deals to our community where we've done our own underwriting, where we vetted these deals, we vetted the sponsors, the markets, and then we bring it to you. And our model has always been that of being a co-GP, which means that we work with the GPs. There's no additional layer of fees. We're directly general partners from the beginning, from underwriting, acquisition, all the way through asset managing till the exit. And at this point, with this new deal, we'll be at over 1,000 doors in assets under management and over 200 million in apartments across the country. Like I said, our goal is always to help educate the community, right? Because as we go through this, you'll realize that there are very few things that you need to look at, but if you don't know that, it can seem very vague and scary to look at a slide deck. So education is a big part of what we do, but it's also to provide our community with market diversification, sponsor diversification, which is important. But our belief is that real estate investing is not a one-size-fits-all. And so a lot of you have had conversations with me in the past. We try to find the right fit for you within real estate. There's an entire spectrum. I want to go over that today because we're actually moving more towards the lower risk spectrum, which is a core asset, which is what this particular deal is. But at different times, you're going to be on different parts of that spectrum. Cash flow may be important to some of you. Velocity of capital growth is going to be more important to others. Our goal is to have those conversations, help you figure out what makes sense for you. Do I invest in Class A? Do I invest in Class B? All of those questions. How does this tie into my overall tax strategy, right? And if I'm trying to diversify, am I picking the right markets? Am I picking the right deals? So all of that personalizing, our goal is to help our investors with that. And then a big part of what we do is also impact investing is a big part of our new why for GW Capital and Generational Wealth MD. A big part of what GW Gives does, which is our charitable foundation, is to help empower children with disabilities in rural India. And I mention this because I want all of you to have pride in that, in being part of that. With that said, let's deep dive into the deal. And so just before we get started, guys, I want to take a few minutes before we go into the slide deck. And I like reviewing the slide deck because a lot of you after the webinar will likely go open up the slide deck, and that's on that landing page. Indira, if you could have CJ drop the landing page in the chat and in Facebook so that people can access that. It's generationalwealthmd.com/Indiana lowercase. What happens is that I'll review all of it, but I wanted to start off with a brief overview of what has shifted in the real estate market per se. And then I want to talk about our strategy and how this particular asset ties into it, and what you should be looking for as you explore the syndication space at this time. And then we'll go through the slide deck so we can get more questions answered. So a lot of you know this. Some of you are already in our community as as active investors directly owning real estate. Transaction volumes have been low. That's in the single family and the multifamily space. We talked about this the last time when we did our Q1 investor webinar. We talked about state of the market. We have another one coming up in a few weeks for Q2. So if you haven't tuned into any of those, make sure you show up. We talk about the entire real estate market per se, what trends we're seeing, where we expect it to go, and how our assets are performing. But transaction volume's been low. Prices have reset across the country 10 to 15%, right? Which is why the assets we acquired in the last quarter, we made sure we had that discount built in. So we had built-in equity going in. So prices have reset. But what we're also seeing, and you all know this, is that interest rates are stabilizing. And in the last year, rent growth in a lot of markets started dropping to where, so almost plateauing, right? In many markets, some markets like Vegas saw negative rent growth, but we're getting back to the point where we're again in that part of the year where rents typically start going up, and we're seeing rents increasing again, which is great. And that shows strength in the fundamentals of multifamily. And if you are interested in learning more, we talked about fundamentals of the entire market in the last webinar. And then if you join us on the next one, we talk a little bit more about it. But again, multifamily fundamentals are strong. That being said, we cannot invest the way we did a year ago or 2 years ago. And so how are we shifting how we're investing in real estate? So I always talk about this. There are three main things we look at when we are assessing a deal and doing our due diligence. And I think you need to focus on this as investors as you're looking at deals. The first one is going to be how we buy our assets and how we're buying has shifted. The second is going to be assessing the asset to see the deal, to see if we have the ability to hold the deal. And there are a few things you need to look at. We're going to go over that. And finally, the third thing is we don't control, so we don't have a crystal ball, right? So we don't control market prices, rent growth, but there are things that we can control. So what are the things that we have in place that we can control that essentially ensures that we have the highest risk-adjusted returns, right? So those are three big categories. Before I dive into that, and before I forget, I just want to know, a lot of you on here have already committed for Class A shares. Just a pointer, we're over 75% subscribed for Class A because it's only the raise per se is a smaller raise, and we're taking 15 million of equity to the table. 1.5 million of that is Class A. So if you are looking at Class A shares or blended Class A and B shares, please make sure you sign the PPM as soon as possible because we will not be able to carve out more Class A shares. That's going to dilute Class B returns. So just for anyone on here who's interested, I wanted to make sure I mentioned that. But going back to how we're buying assets, things have shifted. So we're very conservative in what we're buying. When we're thinking about buying, the first thing is going to be the markets that you buy in, right? Buying in landlord-friendly markets are going to be super important. And that's because in the event of having a tenant who's delinquent, who's unable to, refuses to make payments, you're able to evict, maintaining rent, income, maintaining occupancy with paying tenants. That's going to be key if you're preparing for uncertain times, right? So going to the right market, strong economic growth, all of that is important, which is why this market makes great sense. Indiana is a landlord-friendly state, tons of industrial development over there. We're going to talk about that. Another thing that, and if you're working with different sponsors, you will notice this. There are two trends, two camps I'm seeing right now. Numbers with interest rates being the way they are and prices staying where they are not penciling out for a lot of deals. The reason there is such low transaction volume is because there's a gap between what sellers are expecting and what buyers need the numbers to be for the deal to cash flow, right? Now, that being said, we're seeing some sponsors go into development deals, build to rent, and that's the only way they can make numbers make sense to provide their investors with returns. And that makes sense. But there's also a second camp where we're seeing sponsors go into more, it's called flight to safety and quality. And this always happens in uncertain times. So you're going into deals that have less risk, that cash flow day one. And those are the kind of assets we're looking at. We're not looking at those deeper value add deals. We're looking at more deals that cash flow day one because, they're high occupancy, they're newer vintage, newer assets per se. And those are the kind of deals we're looking at, right? So in terms of strategy, we're moving towards lower risk deals. And if you've heard me talk about this before you know this, as far as real estate is concerned, on the risk reward spectrum, there's a spectrum, and opportunistic deals or your ground up developments, they tend to be higher risk, higher reward. And then you have your core assets, which are assets that are, brand new, cash flowing, but there's really not much room for adding value and increasing your return significantly. And smack in between those two, you have your core plus assets and your value add deals. And what those deals do is that, yes, you have cash flow, but you also have the ability to go in and increase the value of the property by increasing rents. And most of you know that with multifamily, it's different from single family. Your prices aren't set by market prices, it's set by the income that's generated by the property. And that's why when you're in that core plus and value add space, you're lowering your risk, but you're also increasing your returns. And so this particular deal is closer to core plus, bordering on value add. And that's because it's a newer vintage deal. This is a 2018 asset with tons of amenities in there, Peloton bikes, attached garages, dog parks, pool, all of that, larger floor plans. So those are the assets we're looking at, because those Class A assets tend to be more recession resilient, because the demographic of people in there tend to have higher incomes, and they're able to weather recessions. They're able to keep paying, unlike, say, unlike tenants in Class C assets, where they may have difficulty paying in times of economic uncertainty and recession, when unemployment starts increasing. So that's our strategy as far as what we are buying, and I wanted to be clear about that. And so that's reflected in this particular deal. The next thing is going to be, how do we hold? How do we ensure that we can hold the deal? Like most of you know this, commercial lending is very different from conventional mortgages that you get for a single family home, where you get a 30-year fixed loan. That's not what we see in the commercial space. Most loans have a duration of 10 years at most, right? And then some of them have variable rates, they have balloon payments, and this is where you're seeing distress in the market, and that a lot of that has to do with the debt on the deal, right? And so the debt on the deal is going to be super important. This particular deal, and we've been talking about this a lot, so you likely already know this, we have agency debt, which is the safest kind of debt you can have, at 3% fixed for the next 7 years. So as far as debt is concerned, we're taking a lot of risk off the table by having the right debt product. Another thing that we talk about is DSCR. For those of you who are new, I'm going to break it down. DSCR is debt service coverage ratio. All it goes to say is, what's my income from the property after taking off expenses except mortgage, and how does that compare to the overall mortgage payment? And typically, you want your income to exceed your net operating income, to exceed your debt payment, annual debt payment, by at least 25%, right? So lenders will say, I want it to be 1.25, and you hear that a lot. And when you have a deal that's cash flowing really well, like this asset over here, our DSCR in year one is 2.25, which means our income is more than twice the amount of debt payment we have, the annual debt payment, mortgage payment that we need to make, right? So that's amazing. And the average DSCR over the whole period that we projected is about 2. So that's, if you've been in our other deals, or you're looking at other syndications and you've been in the space, you know that that's a very, very high DSCR. Usually people are anywhere from 1.25 to 1.5. And so all that goes to say is that we are de-risking the deal by purchasing assets that have a high DSCR in this environment, right? So the debt, the DSCR, the next thing. So what else can affect your ability to hold a deal in uncertain times? It's going to be vacancy and the inability to push rents up, right? Because all of those affect your income. And that's where, again, market due diligence comes into place, the sub-market due diligence. So this particular asset is in Goshen, where there's very limited Class A. The asset has had 98% occupancy for the last 4 years, and there's a wait list constantly. And that just goes to show that, there's demand and there isn't enough supply, which again affects your vacancy, right? Keeps your vacancy pretty low, and that's amazing. That's what we love about this asset. There is a huge demand supply mismatch in this asset class in that market. And then the second thing is going to be income, right? If people don't have the income income growth or the income to actually pay those rents, that's when you start seeing occupancy dropping, right? And you don't have the ability to push up rents. And both of that is eliminated when you have a population where median income, this is what we look at, median household income, right? The median household income needs to be higher. And it's closer to 80,000 in the 5-mile radius of this property. The people in here, 50% of them have white collar jobs. There are medical professionals and there are people in the education space, logistics. And all of that just goes to show the strength of the demographics and their ability to pay and our ability to maintain the rents and keep occupancy low, all of which affects our ability to hold the deal, right? So again, very, very strong deal from those terms going into uncertain economic times, right? And then finally, I just want to mention that some of you are more knowledgeable in the space. Break-even occupancy, something we look at. How much does occupancy need to drop before we're not able to meet our debt payment? Usually, we want it to be at 80% or lower. So if occupancy drops to 80%, you still need to be able to make your mortgage payment. That's the benchmark that we use to assess deals. The break-even occupancy for this deal is 65%, which means that unless occupancy goes from 98% where it is today to under 65%, we're still going to be able to make our debt payment. And those are important things to look for in the multifamily space. So that's as far as holding. What can we control? We can control value add, right? Can we increase the rents? What is our plan for that? And again, there's a 2-phase value add in this deal. Now, this is a core plus deal, which means it's new, it's cash flowing day one. That's why our DSCR is so high, but we still have a plan to go in and add value. And that's going to be 2-pronged. The first thing is going to be purely operational, which means we're not going to put in CapEx dollars. We're not going to put in money to increase the value of the property for the first phase. We're going to go in and bump up rents. There's already what we call a loss to lease or a catch up between what market rents can be charged and what current leases are. Between that catch up and then RUBS, billing back utilities to multifamily tenants. Some of you who own multifamily know this. This is an easy way to capture rents and increase our income. That is not being done in the property currently. Utilities, electricity, cable, internet, valet, trash. The tenants aren't paying for that. And that's something we can easily have them pay for and thereby increase our income. That is already the seller is already beginning to execute that. So we know that there's proof of concept over that. That's very easy to do. Between loss to lease, between catching up on market rents and the ability to bill back utilities to the tenants, there is huge value add over there in year 1. And then year 2 to 3, that'll be at the point where, now this asset was built in 2018. 2016 was likely when it was permitted. 2014 was when it was designed. So when we go to, sorry guys, hold on one second, having some technical issues here. You guys hear me okay? Just wanted to make sure I was plugged in.
Yes.
Okay, perfect. Okay, excellent. Yeah, so like I was saying, so year 2, the phase 2 is where we're going to go in. So 2014 is when it was designed. So by the time we're in year 2, year 3, we will have the ability to go in and do a light value add over here, $4,000 per unit, do a tech package, thermostats, smart locks, change the fixtures, put a backsplash on, granite to quartz countertops, little things which will be able to give us again a bump in rent, right? So that's a big part of our strategy overall. Go into really safe assets where if you did nothing, you'd still be fine, but then have all those plans for increasing value. That's something that we have that's absolutely in our control. The plan is to increase the income of the property by $650,000 over the course of the hold period. And so what that does is that because multifamily is valued based on your income, when we're increasing the income by that, it's a simple formula: net operating income increase divided by the cap rate, which the average cap rate for this market is about 5.5. That will give you a $13 million increase in value over the course of the hold. And that's the business plan, right? So that's something we have absolute control over. We have proof of concept because our partners have another 400 unit unit in the same market where they're able to do the same thing, where they're noticing that consistent rent growth. And interestingly, if you guys have been following latest data in year-over-year rent growth, like I mentioned, some of our markets are seeing negative rent growth. Indiana is leading the country in annual year-over-year rent growth. So all of those things, positive things, where we know we're going to be able to execute the business plan. We have economies of scale with the other 400 plus unit in the market where, again, exit strategies, we can exit selling this to an institutional seller, which gives us more opportunity when time comes to sell. It also gives us economies of scale with the same property managers. So we know that the business plan, it's tried and tested. We're going to be able to go in and execute. But then the other big thing is going to be the tax benefits, right? And I mentioned this because I see people, who invest sometimes in, say, debt funds. And I actually was on a podcast recently, and I heard someone say, and I hear people say this all the time, I'm in a debt fund getting 7%, 8%, or even 10%, right? How is that different from, say, a 10% that you'd be getting in a Class A over here, or the 15% plus that you're getting? There's tax efficiencies, and that's something we have control over. So what that means is that when you enter this deal as a limited partner, you get passive losses on your tax return, right? And that's because of depreciation. It's not because the property is at a loss. It's a paper loss you get to take because of depreciation. That's a benefit that we get as real estate investors. So when that happens, what you'll see is that that ensures that over the course of the hold, all the returns that you get from the deal essentially are going to be tax-free for you. And so that differs from, say, getting interest from money in a CD or having money in a debt fund, because all of that income that you make over there, treasury bills, all of that gets taxed at your marginal tax bracket, which for someone like me would be 50% in California, right? And so your returns are diminished. The advantage of real estate is those tax efficiencies. Some of you have passive income. You can immediately in year one significantly reduce your tax burden with those passive losses. So tons of strategy over there. And so going back to those three things: buying the right asset, having the ability to hold that asset, and then controlling what we can control. All of those things have shifted. We have shifted in our strategy, and this asset is in line with what we're looking for. And they're very, very hard to come by. It's been very hard to underwrite and find something that pencils. But I think I want to give you that brief overview, because whatever you're looking at in the next 12 months, I think that's a safe strategy, and that's something you need to consider and keep in the back of your mind. That being said, I'm seeing some questions in the chat. Go ahead and start popping questions in there, even if they're the most basic questions. I assure you there are 5 other people on here who have the same questions, and so don't feel free to put any questions in there that are even not deal related. But I'm going to go through the slide deck right now, and as I do it, I'm going to help you understand what to look for. And like I said, this is also very educational. We'll talk about key metrics that you need to keep an eye on, and what industry standards are, and how do you de-risk, take a look at, do your own due diligence and risk analysis for any deal. I'm going to talk about timelines in terms of funding for the deal. Again, like I said, this is a very small raise compared to the last raise. And so especially if you are looking for Class A deals, for Class A shares, make sure you sign the PPM as soon as possible, because once commitments are in for Class A, the portal will automatically close Class A shares. So if you're looking at blended, mixing Class A and B to get a little bit of both the growth as well as cash flow, or just pure cash flow with the Class A, make sure you get that in as soon as possible. It is a loan assumption. We anticipate it to close in August, but as soon as the deal closes, the portal will close out. Tax benefits, we talked a little bit about it. We anticipate bonus depreciation to be between 50 and 65%. We're waiting for final numbers from our CPA. And if you're considering Class A shares, this is probably, again, we're at 9% returns for Class A. This is probably one of the safest deals. If you're getting into Class A in a value add versus Class A in a core plus, it's like a no-brainer. The core plus and core Class A shares are obviously significantly lower risk for the same return. So I just want to make sure, because I know a lot of you committed a lot to Class A. I just want you to sign and get in. Make it, like I said, we cannot expand our Class A pool just because it'll lower Class B returns, and it's a smaller raise. So just want to make sure everyone's aware of that. Okay, perfect. Let's deep dive, guys. So over here, these are the things we were talking about. Occupancy is above 96%. It's close to 98%. DSCR, this is what we talked about. What is the income relative to the mortgage payment? That's what it is. And you want this to be at 1.25 or higher. You can see how high this is. Just goes to show that this is an asset that is cash flowing really well from year one. And we have, again, plotted it out for a 5-year hold. Obviously, we always do that just so that the expectations are set. But depending on market conditions, if we can give our investors the returns that we have predicted earlier, we will look to exit earlier. Equity, we talked about that. Class A and B. I am going to talk about, for those of you who are new and trying to think about whether Class A or Class B makes sense, there is this particular slide where I'm going to go over that, and we can talk a little bit more about when would blended returns make sense. So again, it's a 2018 build, really large unit size, close to 1,200 square feet per unit, which is again, it's a luxury. And if people in times of recessionary times, people want the dollar to go further. So if they're able to find something that's really nice, they're more willing to pay for those assets with more amenities. So again, just a top-notch Class A asset. We actually have the drone footage on the landing page. So if you want to go take a look at it, that's available. Again, 9 feet ceilings, low density, 14 acres, constructed over 14 acres. Again, institutional seller, so it's well maintained. Really, no significant large capital expenditure items to go into as we acquire this. But that being said, again, we're seeing that new lease trade out, right? So whenever a new lease is renewed and someone's renewing it, we're seeing a bump in rents again. So there's that. That's part of the operational value add I was talking about. When you have a difference between what rents are at and what market rents can be commanded over there, then you're able to bump it up, and that's an easy low-hanging fruit, loss to lease, catching up market rents and thereby increasing our income. When you see a property with a wait list on it and really high occupancy, that also goes to show that the sellers current operators haven't optimized where rents can be, because that's not a good position to be. You want your rents to be at a point where you have a little bit of vacancy and you don't have a wait list, but then you're optimizing your returns on your income, right? So all of that, things that we talked about, again, market rent growth, like I mentioned, Indiana is actually leading nationally in year-over-year rent growth, which is a good thing. And this is because of multiple reasons, but it's also because real estate is hyper local, and every market has seen rents go up at different rates. So it's always between what rents, how much rents went up in the past, how much what the demand supply mismatch looks like, and how much incomes have gone up, so that people are able to pay that pay those rents, and it actually makes sense for them. So, but with the balance of those three things, and that being different in different submarkets, this submarket has seen, is leading the nation as far as rent growth, which is good for us. That's great. And then this is the value add plan we talked about in the first phase. It's going to be about, building back utilities. Very easy to catch up, no real expenditure, just being able to increase income without any expenditure. And we talked about economies of scale, having the other asset, which increases our exit options as we go along. This just goes to show loss to lease, and which we already talked about, right? And occupancy, just more specific data. Okay, the returns. I want to talk about returns, and usually in most of the deals we've been in, so Class C is reserve class, right? This is for someone going in with 500K or more. And I say this because I know some of you on here have committed like $400,000, $450,000. And if you feel like you can add and get to the 500K point, that gives you a boost, because the profit share switches here from 70-30 for Class B to 80-20. And the preferred return also goes up, and therefore all of your metrics are much better. So that's something to keep in the back of your mind. But for most of you, you're going to be looking at Class A and Class B shares. So I want to talk about what that is. And some of you may already know where you want to go, but there are a lot of you on here who are new. So let's talk a little bit about that and talk about the metrics we use to compare things, right? Now, Class A shares are just for people who really want just cash flow. It just means that if you put your money in the deal every year that you're in the deal, you're getting 9%. And in this particular deal, we're going to pay out monthly. Your distributions are going to be monthly. And so you get annualized returns 9% for every year that you're in the deal. And again, like I said, this is tax advantage, right? So 9% over here does not compare to 9%, say, in a CD money market, or in bonds or in a debt fund, right? That's different because you don't have to pay taxes on it. So you get the preferred return 9%, but you don't get a profit share at the end. And who does this work really well for? It works for people who are very low risk, who are more about capital preservation. And it works well for people who are later in their career, who are planning to cut back or retire in, say, 3 to 4 years at least, right? 2 to 3 years. So then you're more concerned about cash flow rather than capital growth, because you want to live off of it. So I've had friends whose parents wanted to invest in Class A, and that's the thing that made the most sense for them. Now, there are, I'm going to talk about blended returns, because some of you may want to get a little bit of A and B, and that is an option that you can pick on the portal. So consider that as we go through this. But again, when you're getting that 9% every year, that keeps you at a return of 9%. And then your equity multiple, what happens to your money if you put 100,000 in? Equity multiple means, and this is for a 5-year hold, right? When you're comparing equity multiples between two deals, you have to make sure the whole period is the same. Because if someone doubles your money in 2 years versus doubling your money in 5 years, those are two different things, right? So this is for a 5-year hold. If you put 100,000, you get 145,000 at the end of 5 years, right? That's a 9% return. That's what equity multiple is. Now, what's IRR? How is it different from AAR? AAR is average annualized return. So if you take your return over the entire 5-year period and divide it by 5, that's your average annualized return. You're averaging your returns over 5 years. This is the easiest way to compare real estate returns to stock market returns. Because often you're just holding and it's appreciating, but you're not really cashing out, right? So I think AR is a good way to compare stock to real estate. Now, what is IRR? How is that different? That's internal rate of return. What IRR does is that it factors in time value of money. So if you have a deal where you put 100,000 in, and so some of you are in our McDonough deal that the last year we were in Atlanta, you know that in year 3 you get the bulk of your money back, right? So if you put $100,000 in, year 3 you get 75,000 back, which is those numbers from that particular deal. And then year 5 you get the rest of your money back. You get $125,000 back, right? That's different from being in a deal where you get no money for the first 4 years, and then in year 5 you get $120,000 back. Now, sorry, $200,000 back. Now, in both of those scenarios, in the first scenario, you put in 100,000, year 3 you get 75, and then year 5 you get the 125 back. You got $200,000 back. So equity multiple is 2, right? And then if you had a different syndication opportunity where you put in 100,000, year 5 you get $200,000 back. Your AAR would be the same in both, right? Because averaged over the course of those 5 years, you've doubled your money. So your equity multiple is 2 for both of those. Your AAR is going to be 20% for both of those, but your IRR is going to be different. So in the first deal where you get the bulk of your money back in year 3, like our McDonough deal, your IRR is going to be higher because you get the money back, you reinvest it, you get higher return. So it's factoring in the time value of money. That's what IRR is. And so for Class A, IRR and ARR is going to be the same, but let's go into Class B, right? Class B is for someone who is, say, in their 30s, 40s, 50s, and they're not looking to retire in the next 5 years. They're more concerned about velocity of growth. They want their money to grow rapidly, and they're less concerned about consistent cash flow, right? And so for Class B, you still have 7% preferred returns. But when we go to the next slide, I'll show you in the first few years in the deal, in most deals, you're probably at 2 to 3% in year 1, and then it slowly starts bumping up as you're adding value and rehabbing the properties and increasing the rents, right? That happens over time. This particular deal, because we're already high on cash flow, for Class B, you're probably going to be, our projections are 5% and 6% in year 1 and year 2, and then you get to 7% returns, right? So you're supposed to get close to 7% in returns. Preferred returns just means that if you don't get that in the first few years that you're in the deal, when our cash flow exceeds the 7% that's paid out to you, before the sponsors, before the operators get any cash, you are caught up for those years in the deal where you didn't get that 7%. That's what preferred return means. So you accrue that 7% as a Class B investor that you haven't, if you haven't received it out in any year, you get caught up for that before any of that cash flow goes towards the operators, right? Towards their share. And then unlike Class A, during sale, you also get profit from share. So during sale, the debt is paid out, you're caught up, Class B investors are caught up on their preferred returns, everyone gets their capital back, the investors do, and then whatever is left is split, and you get 70% of the profit share as a Class B investor. And what that does is that will bump up your AAR and IRR compared to Class A. So you're getting about 15% average annualized return over that hold period, which is higher than what you get with Class B. And for anyone who's looking to grow their money rapidly, that makes more sense. So your equity multiple is higher also, right? Now, like reserve class, because you're putting in higher, you're getting an 80-20 split, that increases your IRR and AAR also. Now, if that's confusing, don't worry, the next slide, actually, we can skip this slide. It shows you, and so this is all there in the slide deck, guys. So this is slide 16. So if you ever need to go back or you're talking to your spouse and you need to explain it, or you're comparing two deals, I think this is a good way to compare it. Take a look at that previous slide, 14 and 16. And this just shows you, if you put $100,000 in as a Class A investor, what can I expect over the next 5 years, right? So these are projections. For Class B, what can I expect? Like I said, you'll be at 5% and 6% and then hitting 7% over time as we execute the business plan. And then all of this, that where you don't, these years where you don't get the 7%, that accrues, and anytime cash flow exceeds 7% in a given year, you're paid out. So you're caught up as far as that 7% for every year you're in the deal before the operators get their share of cash flow. Anyways, so that's that. Any questions about this, we can always talk about it. So again, it's supposed to be, so the equity multiple of 1.7, right? So if you put 100K in at the end of 5 years, this is what you expect to have gotten back. IRR factors in, AAR just takes this and averages your return, like 70% return averaged over 5 years. IRR factors in the fact that you're getting cash flow. And IRR is an easier way to compare to real estate deals because it factors in money that you're getting over the course of the deal. AAR, I think, is a better metric to compare real estate to the stock market. And so, yeah, so that's that. Let's see, bonus depreciation. I'm going to quickly go over the rest of the slides because I don't want to take up too much time. We're at 40 minutes right now. I'm going to quickly go over it and then we'll open it up to Q&A and we'll try to get some of those questions answered. So like I said, many of you know that we have, so bonus depreciation is phasing out. Last year was the last year for 100% bonus depreciation. This year, we still have 80% bonus depreciation. What does that mean for you? If you put $100,000 in, you will likely get a K1 end of the year as a passive investor that your CPA will use to file your taxes, where it'll show losses, because that's one of the perks of being a real estate investor. And those losses are passive. That can, so any income you make from the property, you don't have to pay taxes on. On the back end, you have the ability, if you are in multiple deals, you will probably have more passive losses in there. You have the ability to shelter capital gains and bonus depreciation and depreciation recapture at the back end. If that is not the case, most of our deals will always give our investors the ability to 1031 into another deal as an LLC. You can exit if you want to. 90% of the time, we work with our partners to ensure that that is a possibility for our investors. And then you again get to defer having to pay the taxes. Now you have $170,000 to $200,000 that you're putting into the next deal that gives you higher cash flow over the course of the deal. And that's again going to be tax-free because of depreciation, right? That's the goal. The good thing is there is a law that is making its way through the Senate, where they're trying to extend bonus depreciation till 2026, 100% bonus depreciation, which would be great because then you have the ability to enter and exit deals without really by worrying about bonus depreciation, about the tax implications. You don't have to do a 1031. You can just do what we call a lazy 1031, get into the next deal, use those losses against the gains over here. It would be very simple. It would be excellent. But even without that, we're still at 80%. So it's still a great year to get into passive syndication deals. And if anyone needs clarity on this, we can talk about this more towards the end. Just drop your questions in there, okay? We talked about this. I think we know what the loan terms are. It's a 3% fixed interest rate. Like I said, the blended rate with the supplemental loan is still under 4%. And that's amazing because it's very, very hard to get these kind of deals. And this is the only way we can find, we found a deal that's a core plus asset. It's very cash flow heavy. And with the debt being the way it is, it's completely de-risking this deal, which is what we like to see in this environment. Now, This is a sensitivity analysis table. And what we want to know is, this is what we use to predict where we expect to sell, what we expect the asset price to be, and what returns are going to be. And so the question is, for those of you who are a little more sophisticated, exit cap rates, that's an important thing to look at. What is the exit cap rate going to be? And so what's a cap rate? So cap rate is essentially, what is my net operating income, right? My income minus expenses without factoring debt in, right? Net operating income, what is the purchase price of the property? And so net operating income divided by the purchase price or the sale price, that gives you, so it's like cash on cash return, but for a property that doesn't have a mortgage, right? That gives you the cap rate. Now, the average cap rate in the market for a Class A asset in that submarket is 5.5, which is what we're using for our assumptions. But if you want to see, and so exit cap rate is actually a function of market sentiment. So essentially what it says is that how much are people willing to pay for this net operating income in that market for a Class A asset? Class A assets have lower cap rates, which means people are willing to pay more for lesser income because it's less risk in the deal. And so a Class C asset will have a higher cap rate, which means people are willing to pay less because the denominator is the purchase price or the sale price, right? The people are willing to pay less for the same income. And that's the easiest way to look at it. So it's just a factor of market sentiment. And so if you feel like, oh, well, I think the market's going to be really much worse and people aren't going to be willing to pay it, so then you decompress the cap rate and you look at returns. But if you think, I think the market's going to be strong, that's where you go into a number like a lower cap rate and you look at what returns are. And so returns will vary depending on what number your sponsor is using for the exit cap rate. And so this is based on the long-term average cap rate for that market over decades. Okay, so we talked about this, the two-phase operational value add in the beginning, and then the actual expenditure of capital expenditure to improve the units. That's what we're looking at. So two-phase. This is, again, what do we control? How do we control it? And have we done our due diligence in terms of how much rent can the submarket command? What are people willing to pay? And so, like I said, having that 400 unit where we're actually executing the same business plan and knowing the trends in rent growth in that submarket, all of that, and actually executing the billing back in that particular asset, that is just proof of concept, right? So we know that we can easily do this, and it's not, we're not stretching it over here. It's actually very conservative in our estimate. Quickly wrapping it up, let's see, have I missed anything? Nearby competition, I talked about it. There are very few Class A assets in the submarket. So that's where I talked about the absorption, the demand supply equation. That's something you really need to look at when you're going into a new submarket. So we know, and that's also evident in the fact that we have a wait list for people trying to get into this property, right? We talked about the debt. It's a 3% interest rate. It doesn't get better than that. Very hard to get those loan assumption deals. That's the only way to make a lot of deals pencil out, make sense. Institutional quality asset, strong employment drivers. If you're going through the slide deck, and I'm going to let you do this later, you can see all the employers in the market and how strong the economy is. It's the RV capital of the country. So a lot of data over there that you can take a look at. That's a big part of market due diligence. Is it landlord friendly? What is population growth, job growth, income growth like? Is there enough, employer diversification over there? All of that is really important. Again, like I said, the units are excellent as they are, but in a few years we can upgrade to quartz and do a little bit of value add a backsplash just to increase the value and command more rents. That'll be part of our phase 2 value add. A big part of what we're doing, so again, tons of amenities, fitness center, Peloton bikes, all of that. A big part of due diligence is also going to be what are market rents for similar properties that are this. So ideally you want to look at a range, but what you're actually using for comparisons are properties that have the similar amenities, that are of the similar age, same condition, right? Well, condition doesn't apply as much to this asset because it is a newer asset, but also the size of the units, right? So if you look at that, if you look over here, it's 1.4 is the rent per square foot for our asset, and the market average is 1.68. So it just shows that that's the loss to lease. That's the ability to go and increase rents. And so again, it shows over here that people with similar size properties are able to command more, anywhere from 155 to 872. That just is part of our market due diligence. For 2 and 3 bedrooms, you're seeing there's a higher gap in terms of what we can command, right? And that's important to notice because that just means that that's just proof of concept for our business plan, right? Where we go in and increase rents. And those are easy things without an expenditure. That's the kind of low-hanging fruit that we like to target. Again, I'm going to let you guys go over this in terms of employers, but the important thing to note over here is that healthcare, logistics, education, that's a big part of the employers. And that just means that in this particular asset, especially, a lot of the tenants are in that demographic, which the white collar and gray collar jobs, which tend to do well during recession. And then they also, delinquency is less of an issue over there. Again, that's what we look at, right? We look at the median household income in a 5-mile radius, and typically people pay up to a third in rent. So you want, if our rents are, if a plan is to bump it up to 2,000, you want the median household income to be 3 times that, which is 6,000, which annually is 72,000. Median household income, even at this point, is about 78,000 and higher. So that again is an important thing, because if you don't have that, you're not going to have the room to raise your rent. So we're good and strong as far as that metric is concerned. This Elevate on Main is the other 400-unit asset that our partners have in the area, which is where we already know that this business plan is going to work, because it's worked over there. They've been able to raise the value from 76 to 86 million. And then we have operational efficiencies using the same operators. Again, University of Notre Dame, lots of universities, healthcare, professionals in the area. This is what I was talking about, the average household income. It's also called median household income. This is a number that you really need to pay attention to anytime you're evaluating a syndication. Close to 50% of the people have white collar jobs. Again, that's really important. I mean, you're thinking about vacancy and delinquency, right? Just rushing through this. Again, this is a lot about the market. It's 2 hours from Chicago, 2 hours from Indianapolis, a lot of growth related to that. And just more slides about the employers per se, and the growth, job growth, population growth is all related to this, right? So this is your market due diligence. This is something most sponsors will provide you with. What is it close to, right? It is the RV capital of the world, and what is the economic impact of all of these jobs? You do definitely want to make sure there's employer diversification. That's an important part. But just quickly, again, like I mentioned, number one, not in the nation, year on year for rent growth. That's an important metric to look at. But over Indiana, you will notice that the across the country in the Sun Belt and some states in the Rust Belt, Midwest, are going to be landlord friendly and also business friendly. And so those two go hand in hand, and we're looking for both of those things, right? When we're looking to acquire real estate. Employment, we discussed this, financial analysis. So this is actually the actual business plan. And you'll notice that the goal is to increase the net operating income by $650,000. This is what I talked about, which increases the property value by 13 million. And if you have any questions regarding this, feel free to drop it in the chat. We can go over it. After this, we talk about our portfolio per se. I gave you guys a little bit of an update, and we talk about our partners' performance in that market and other assets that they've acquired over the course of the years. Elevate on Main, this is information about the other asset we have in South Bend. But wrapping it up, guys, if you go to the landing page, and you can use this to scan it, there is the slide deck is available on the landing page. We will have this investor webinar uploaded there shortly, but there's also a button to book a call with me. If you have further questions, if you want to talk more about your specific situation, then make sure to book a call. But I also want to let you know that if you're looking to soft commit, there is a link on there where you can click on it. You can fill out the soft commit form. When you do that, an email will be sent to you automatically with instructions on how to register in the portal. It's very simple. Many of you are already investors with us, but it's the InvestNext portal. You go in there, you register, you sign your documents. If you're looking for Class A or blended returns, I don't think we touched on blended returns. Let me touch upon it quickly. Class A, or you're trying to do a combination of A and B, which is what we call a blended return. Make sure you do that sooner rather than later. That's going to close out fast, and then that part of the portal will get taken down. But if you have any questions, there are links in there to get in touch with us, or with the team, to get in touch with me, book a call with me. You have the ability to do that. Before I go to Q&A, before I forget, I want to quickly make sure I talk about blended returns. Now, For some of you, and maybe I did, I may have talked about this, but blended returns is for those of you who, want a little bit of cash flow, but are also concerned about velocity of growth, and you really don't know if, both of them make sense to you. You do have the ability to go into the portal and split your investment between Class A and Class B at this time, because we still have Class A open. And so if that's what you choose to do, that is a viable option. And if you want to talk more about it, feel free to book a call. We can always do that. Let's go over the questions quickly. And then if I'm taking your question and you want to unmute, feel free to do that. As far as, I think this is a question I've been asked by a bunch of you, so I'm going to answer that. Why the sellers are selling? They are institutional sellers. Their hold period was targeted for a 3 to 5 year hold, and that's why they're selling, because that is the expectation that was set for their investors at the get-go. Poonam, the cap rate is the exit cap rate is 5.5%, and it's on the slide deck if that's what you're looking for. Okay, perfect. I think someone answered that question for you. Yes, perfect. It's a big PDF. Yes, it does take a while to load if you're trying to do it on your phone. Class A member criteria. So I'm going to go over that. And then if I haven't answered your question, feel free to, if I haven't understood the question and I haven't touched on something you want to talk about more, we can always go back to it. So Class A, so most syndication deals, and most of them, the terminology is the same across the board, right? So Class A is when you're looking for, so you, as an investor, I always say the first question is not vetting the sponsor, vetting the deal, vetting the market, right? Before you vet the deal, vet the sponsor. You really need to trust the sponsor, make sure that their business plan, and you know, like, and trust them. Before you, I think that's more important than even vetting the market, because the right sponsor will go into the right markets. But, and this is, I'm going to talk about this a lot in the ebook that is coming out next month. Before you vet the sponsor, you need to make sure that you're clear about what your goals are. Are you looking for low risk, low return, or high risk, high return? There's a spectrum, right? Are you looking for cash flow, or are you looking for capital growth, velocity of growth? What hold period makes sense for you? Do you want your money out in 4 years so you have options? Do you want to go into a 20-year hold, right? Those are all questions to answer. And so Class A basically boils down to, do you want cash flow, or do you want your money to grow more rapidly, right? Because Class A is for, I call them the safety seekers, right? People who want to be low risk, who want to see consistent cash flow coming in. That's what's important to them. They may be towards the tail end of their career. They may be looking to retire soon. They may just want to cut back on medicine, and the cash flow is really critical to them. Those are the kind of people. And then they may just inherently be lower risk. It's all about capital preservation. Now, this deal screams capital preservation on so many levels, even for Class B. So it is a lower risk deal because it's more closer to the core plus. It's a core plus asset. But for those of you who want Class A assets, because the consistent monthly cash flow coming into your account is important, and for this particular deal, it's 9% annualized returns in terms of just cash flow. That's what Class A is for. That's for someone who isn't looking for a portion of the profit on sale. They're just looking for cash flow. That's Class A. Class B is the investor who's more concerned about velocity of growth. You may see but in this particular deal, Class B still gets 5% or more returns from cash flow starting year one, right? That's the best part about this deal. But it's someone who doesn't want a 9% AAR. It's someone who wants a 15% AAR or a 20% AAR. Now, because this is a core plus deal, you'll notice that the AAR is about 15%, and that's because we're trading returns for safety, which is the stance that we want to take at this time. But it's still significantly higher than what you're getting with Class A. And so if you want velocity of growth, if that's the stage of life that you're in, and that's what makes sense for you, then that's what Class B is for. So hopefully that's simplified it a little bit.